Morning, everybody. Thank you very much for dialing in, and I look forward to running through our presentation for you. And of course, very happy for Samir, our CFO, and I to answer questions at the end. I'll run through the overview and then cover some of the flows, the AUM, fund performance, and then Samir will cover the financials in a lot more detail. But just as an overview, highlights, average AUM increased by 15% over the 6-month period. Core operating profit increased by 21%, and adjusted diluted earnings per share increased by 42%. Net inflows over the 6-month period of 472 million. I'll go into more detail about the profile of those flows in a few moments. I'm pleased to say fund performance improved when I compare this period to last year this time. And of course, we've launched a new fund managed out of our Florida office, International Small Company Mutual Fund. And we held our first interim dividend at 14p. Turning to the market backdrop, and again, you've all lived through this, so I won't go into a huge amount of detail other than to say, again, you can see that top blue line rising from bottom left to top right is the Dow Jones World Technology Index. So obviously, we've had that tailwind at Polar Capital being quite heavily dominated by technology funds and technology AUM. You can see the S&P also a good progression during the period of time. And of course, the bottom, you probably can just see it, is the grey line, which is the VIX index. So volatility relatively low and benign. Moving forward to the next slide, that's the backdrop of pan-European sales. So that's total sales by all asset classes, both active and passive across Europe in the last year. So that's the year to September. And you can see above the line, those are net inflows or net sales across all sectors, dominated by bonds. So fixed income dominated absolutely everything. You can see equities were in inflow, but declining over July, August, September. And net inflows into equities, again, all of it was passive, and we had net outflows from active equities across pan-Europe. So very difficult environment for active equity managers. Turning now to fund performance and capacity. That's the performance of our strategies since inception. What that shows you is everything above the horizontal line is ahead of benchmark. The percentage is indicated. Everything below is behind benchmark since inception. And the color of the bars indicates whether it's first quartile, dark blue, second quartile, light blue, third and fourth quartile. So you can see very good across the range. The two that do stick out are smart energy and smart mobility. Both of those launched in September 21, which, as you're all aware, that was the peak of valuations in the sustainable equity universe. So launch date right at the peak, really struggled. These are all measured against the MSCI World Index, so it's not against their peer group index. Smart energy, which is top quartile, even though it's behind benchmark, is faring very well against its peer benchmark. In other words, against its similar funds and against its universe of companies that it actually can invest in. So overall, a pretty good picture across the fund range when you look at since inception performance. Moving on then to performance against our peer group. So 75% of our total AUM are is in the Dublin UCITS fund range, and we can compare their performance to the Lipper peer groups. And you can see, as at September 2024, 90% of our funds are in the top 2 quartiles against the peer group versus 73% a year ago. And likewise, over 3 years, we've 77% in the top 2 quartiles compared to 48% last year this time. Over 5 years, 97 versus 84. And since inception, 99% of our funds are in the top 2 quartiles since inception. So an improvement year on year in terms of the Lipper ranking. Very pleasing to see. In terms of benchmark, a similar picture emerges where you can see the dark blue bar is performance since inception. Dark blue bar is AUM outperforming benchmark as at the end of September 24, and the light blue is percentage of AUM outperforming as at September 23. So you can see again a marked improvement. The dark blue bars indicating since inception over 80% of our funds outperforming benchmark. Over 1 year, you can see a big improvement compared to last year this time. In terms of AUM progression on the next slide, you can see the capacity remains at over 60 billion pounds, with remaining capacity of 42 billion pounds. And I think importantly, those 4 strategies that we are seeing inflows, we have seen over the last 6 months and currently seeing inflows, there is significant capacity in there. So emerging markets, which has been the real success story over the last year, still has 4.1 billion of capacity. Global healthcare, 7 billion of capacity, and global insurance, over 1 billion of capacity. So you can see a lot of runway in those funds that actually are in inflow. That's the progression of total assets under management since March 2019. So you can see almost back at the end of September to the high watermark. September 21 was 23.4 billion. As of November the 8th, we were at 23.9 billion AUM, having had a lift as a consequence of the Republican election win in the US, which lifted technology stocks. So at the moment, AUM over 23 billion, which is at where it was the all-time high. On the next slide, we look at net inflows, and I'll show on this slide both gross subscriptions and gross redemptions. So you can get a picture as to where we are seeing the gross ins and the gross outs and the net. On the left-hand side, you can see emerging market stars in Asia. Net inflows of just under £1 billion in the 6-month period, so very strong demand for that emerging market fund. Next to that, healthcare, same thing. So you can see gross in, gross out, but net inflow over the 6 months, and likewise global insurance, and much smaller, but Japan has had net inflows as well. Moving more towards the right, you can see UK value. That's flat, so gross in almost equal to gross out. That's fared very well considering how other UK-focused equity funds have done. So we're quite pleased with that flow profile for our UK value fund. European income fund, tough. We've had net outflows there. Likewise, sustainable thematic small outflows. Sustainable funds have become less popular. Convertibles have had net outflows, and so has the European Opportunities Fund, which has had a really tough time, where it invests mainly in small mid-cap European equities, including UK, and they've had a really difficult time. North America continues. So again, 2 issues there. One is the concentration of the index, where they will typically be underweight the MAG 7. So they will underperform against the benchmark, but also just pressure from passives. So clients investing in ETFs, passive ETFs, in North American equities to get exposure to those big mega caps. Technology, you can see a high number of gross inflows, so 750 million of gross inflows, but unfortunately, gross outflows exceeded that. So you can see still small net outflows from tech in the 6-month period. That's mainly the tech UCITS fund. We saw net inflows into the AI fund. So if we split the AI fund out, AI has been in inflow, and indeed it currently is in net inflow. I'll hand over to Samir.
Gavin, thank you very much. For those of us that follow us and know us, the next few slides will cover the financials in a bit more detail. So first of all, looking at the overall highlights and mainly the P&L, as Gavin's indicated, a stronger period for equity markets, better fund performance, and net inflows combines to give us an average AUM that is higher than the comparable period of the first half of last year, up 15%, which feeds straight through to our net management fee revenue line. 87 odd million at the end of the first half, also up 15%. The net management fee yield at 78 basis points is down 1 basis point, but that is within our stated long-term guidance of the expectation that fee margin erosion of 1 to 2 basis points each year is to be expected. And that's mainly a function of two things. One is the industry-wide pressures on fees, but also change in product mix as we take on more institutional clients. Now, our P&L is very, very simple. There are three main components of profitability. The first line, core operating profits. Core profits are really our net management fee revenue less all operating costs, and core operating profits of roughly 27 million at a core profit margin of 31% for the first half. Guidance for the full year is for a margin of 30%. Because if you remember, as we were coming out of the full financial year 24 earlier on in the summer, we indicated that the new international small company team that we were taking on would arrive in the latter half of this financial year. They have arrived. Their fund launched in September, and the costs associated with that fall in the latter half, and therefore the expectation is for a core margin of 30%, which will still be an improvement of 1 percentage point compared to last year. Performance fee profits also arrive in the second half of each year. The vast majority of the performance fees sit within the UCITS fund range, and those fees crystallize at the end of December, and therefore it is not unexpected that that line is a nil balance at this stage. Other income, which is the third component of our overall profitability, includes bank interest income, which is fairly stable period on period. However, the other component is mark-to-market fair valuations on our seed portfolio net of hedging costs. And again, with better equity markets, better fund performance, that mark-to-market P&L is an improvement on this time last year. Pulling everything together, adjusted diluted total EPS for the first half was 24.5p. And bearing in mind that improved profitability and the strength of our balance sheet, the board declared a maintained first interim dividend of 14p, which I will touch on again later on the slide deck. On the next slide, we look at the costs in slightly more detail. And if I talk through the chart on the right, really, again, the vast component of our cost base is staff compensation related. And with improving profitability, the business model is predicated, remember, on a revenue share / profit share arrangement with the investment teams, and therefore the improved profitability feeds into increased variable compensation, and that is what is driving the increased staff compensation cost there. Slightly offset by lower other operating costs. These are the non-compensation related admin costs of the business, which again I'll cover in more detail. And then the final leg is an impairment write-down on goodwill that we were carrying on the balance sheet related to the Dalton acquisition. Again, we'll look at that in a bit more detail. But when you combine all of that together, total operating and finance costs of 67 odd million for the business. On the next slide, on the left, we look at other operating costs. As I said, non-compensation related. The first two lines, information technology, rent and rates, the occupancy costs of the business, are really the two lines where you see inflation pressure, but also predominantly, again, more costs in the admin side of the business in taking on a new team. And elsewhere, we've sort of managed the cost base so that the other operating costs overall are a marginal decline compared to where we were this time last year. The expected run rate for the full year is for it to be fairly consistent with the interim period. So really trying to manage the cost base over the long term sensibly, and really there are no large big ticket expected items that need to be fed into the cost base, so that ultimately, as we are able to increase that average AUM, we should be able to manage larger size AUM with effectively a very similar cost base without letting that creep up. And that's very, very important for the future of the business. Exceptional items, as I mentioned, really driven by the impairment charge on the goodwill that we took on from the Dalton acquisition. And the European opportunities team there has really been under two significant headwinds. One is just the geopolitical climate in Europe and the lack of appetite for European equities, and also their focus on mid and small cap. And really, those two headwinds have combined to effectively result in net outflows, which have fed through into the carrying value of the intangibles that we were holding against the balance sheet on the balance sheet, and hence the decision at the interim stage to take an impairment against goodwill of 5 million. That is a non-cash charge that is going through the P&L. And then the second smaller item is the regular amortization of the remaining intangibles, again related to the Dalton acquisition. If we move on to the next slide, combined cash and seed investments of roughly 115 million at the end of the first interim period really defined the strength of that balance sheet. The seed portfolio roughly 44 million at the end of September. And the new item there is the seed that we have put into the new international small company launch to get that team and fund up and running. That is a US mutual fund for the US market. And the only other change on the seed portfolio to flag is post the September period, we have taken the investment in Forager out, as that legacy long-short fund, which was roughly 100 odd million, has been wound down and closed. The next slide shows a slightly different view of capital in the balance sheet. Regulatory capital requirements for the business remain constant period on period, 26 million. And after allowing for that first interim dividend, roughly 13.6 million, surplus capital on the balance sheet of 64 million, which is a healthy position. And our framework and the way we think about using capital remains consistent period on period. The first use is to think about seeding new product ideas, which really acts as a R&D engine for the business, whether it's new product launches for new teams or new ideas for existing teams. There continues to be a small share buyback program that operates in the background through our EBT, which is really there to dilute the impact of equity incentive plans. We will continue to maintain a strong balance sheet for future growth and challenges that come our way. And then finally, look to return capital to investors through ordinary dividends. And on that point, going to the final slide of the finance deck, first interim dividend maintained at 14p. That equates to a payout ratio of 68% of adjusted core earnings over the first half. And for comparison, that metric was roughly 80% of core earnings last year, this time last year. So again, improving core profitability, the strength of the balance sheet, and improving outlook for the business really gave the board the confidence to maintain that first interim dividend. I'm sure you'll be all very keen to understand what we're thinking about that second interim dividend. That is a decision for the board when we get to the mark at around about June for the year end. And again, the decision there will be predicated on the outlook of the business for the time, what's happening around us. But again, we will factor in the strength of the balance sheet and our confidence in our business at that time. So really a message of improved average AUM, improved profitability, looking to drive the business forward, which underpins the financial health of the business, which is in good financial health. I will close there and pass back to Gavin for strategy.
Right. Just looking at the strategy of the business, we are focused on growth with diversification. That has been the stated strategic intent for the last 7 years, and that has continued. So continue to grow the business, but with our eye on diversification, and that reduces business risk. So you can see the progression over the last 7 years through now. Everything above those hexagons are new product launches. Those below the hexagons are product closures. So you can see we do have an eye on closing down funds that either don't perform or don't have any commercial traction. And that is important because we make sure there's capacity to actually manage those funds that actually are thriving and growing. So you can see a lot of activity over that period in terms of fund launches and closures. As Samir's already said, 2024 on the right-hand side there, we launched an international small company fund with a manager and a team in our Florida office. We launched emerging markets healthcare and a European small cap fund, which essentially is the team that were running the Forager fund, the long short fund, which we've closed down. On the next slide, we talk just a bit about the big success story, which is the emerging markets and Asia team. From a standing start 6 years ago, they're now managing just on £3 billion. Further inflows post the period end, and you can see the performance is outstanding. Now, this is against a backdrop of net outflows from emerging market equities as a sector. So it's been a very, very difficult sector. Net outflows, we've managed to gain market share by attracting assets from our peer group. And that really is two things. One is performance, and second is a very, very powerful process and investment philosophy, which bases itself on sustainable economic value added. Fund now with the team running just on 3 billion at the moment, 4 billion of capacity remaining. And you can see on the lower left-hand side, you can see the progression of AUM over that period of time, really sort of ramping up more recently. So, from 1.3 billion of AUM end of 2022-23 up to just under 3 billion now. So very pleased. Morningstar silver rated, which is very, very good for the US market. We do have an emerging market 40 Act fund, which our US sales team are busy marketing. And then lastly, before I summarize, that's the new team in Florida run by Dan Boston. He's the head of our global small company team, 19 years of experience from Brown Capital, where he was managing $3.5 billion at the time of his departure just on a year ago. And you can see two very experienced analysts joined Dan to manage that fund. So very, very early days. We expect to see some traction over a 3-year period once he gets a track record established at Polar. So we don't expect much flow in the next year or so, but certainly after that, we're expecting this to really drive our US sales, because this fund is launched specifically for the US market. It's benchmarked against the MSCI ACWI ex-US small cap index. And then just to summarize, again, AUM, as I said earlier, 23.9 billion as of the 8th of November. New product launch, strong pipeline for potential inflows. But, and it always is a caveat, quite low visibility on outflows. What we're finding is completely unpredictability in terms of outflows. September was a tough month for us, as it was for the industry, where a lot of UK investors were taking capital gains from their portfolios, so selling down long-term holdings to harvest capital gains, and then hopefully come back in after the budget speech. Fund performance has improved, as I said earlier on, and of course the outlook is constructive now that we have the US election out the way and also the UK budget out the way. And on that note, very, very happy to respond to any questions you may have for myself or for Samir.
What is behind the strength of the emerging market inflows? Is this all driven by performance? Are you seeing weakness in competitors?
As I said earlier, it's two things really. I think it's performance and also a very clear process and investment philosophy, which effectively bases itself on EVA, economic value added, but sustainable EVA. So very, very strong focus on ESG aspects of it. It has sold particularly well in the Nordic region. So that's where we've managed to build a channel. So I think strong support from a lot of previous clients in the Nordic region has fueled that growth over the period. But of course, the Nordic region also very much more focused than other regions of the world on ESG factors. So it's a combination of a number of things, but also taking market share from competitors who have underperformed.
Okay, thank you. Does Polar retain its seed investment for the whole life of the fund, or do you recycle the seed capital into new launches?
Thanks, Anna. Well, no, we absolutely recycle the seed into new fund launches. Remember the EM Stars UCITS version of that fund was seeded when it first launched. We recycled that about 12 to 18 months ago. Some of that cash and cash from improved profitability has gone into the new international small company team.
Okay, thank you. Are you seeing any change in the pattern of flows now that the US election is settled?
What I can say is November we've had net inflows, so we've returned to that net inflow profile. Normally, what happens, I mean, given that our largest team is tech, second largest is healthcare, what typically tends to happen with healthcare is a Democrat administration is normally not good for healthcare, whereas Republican is. I think this time around, what we're seeing with some of the Trump proposed appointees, not good for healthcare at all, where you actually saw an anti-vaxxer being proposed as sort of head of the health administration, and you saw large cap pharma sell off last week. So our team is sort of vigilant in terms of finding opportunity within the healthcare opportunity set, but not at the moment, not good for large cap pharma. But I think a lot of the uncertainty is now, certainly the UK budget that's behind us now. That's a big item of uncertainty gone. All the concern about capital gains and what that's going to do, inheritance tax and so on, AIM, what's happened to the AIM market, that's all disappeared now. And also, we think we know what we're dealing with in the US, and that's going to throw up opportunity.
Okay, thank you. Why have you retained European small cap team for the long only product and closed down the long short product?
It's a very good question. The long short product, the European Forager Fund, has been going for years and years and years. It's one of the original funds at Polar. It's always been relatively small. It's got very small capacity. And what we found over the years is they generated more return from their long positions than from their short positions. So their shorting let them down. Eventually, the original manager retired 3 or 4 years ago. The rest of the team carried on the back of one large institutional client who kept the money in the fund, 100 million in the fund. They have decided to allocate away from Europe as an asset class. So that meant the long short fund, we closed it down. But we had a US family office who were very keen to support the team on a long only strategy. So effectively, we have not seeded that. That's seeded by a client, a US family office client. And that's to support the team and see whether they can actually perform in European small caps specifically. But it's long only, as opposed to long short.
How do you go about fighting back against the growing trend for passive investment?
Yeah, I mean, it is a growing trend. It's much more prevalent, I think, in the US than anywhere else. But the way we look at the world is we try and manage differentiated products. So what we'll try and do is look for teams, and certainly a lot of our existing products are differentiated and also more difficult to emulate with a passive ETF. So that's absolutely critical for us. Where we can't do that, for example, our North American fund, we are facing headwinds. I mean, we are definitely facing headwinds where clients want exposure to that Mag 7 large cap, mega cap companies. They will just invest in the index. I mean, why pay an active manager who's going to be effectively underweight those large stocks when you can buy an ETF? So we are facing it, but the way we fight it is we focus on our highly specialist, differentiated equity strategies.
Okay, thank you. What is the pipeline like for bringing in new teams? Are you seeing outflows putting pressure on competitors and presenting opportunities?
Yeah, so new teams arise from two sources. One is where we actively are looking for new teams. So we strategically say, where do we actually want a team to be? What asset class within equities do we want them to manage? And we'll do a global search and we'll go out. And that's how Dan Boston came in. We were looking for international for the US market, and we currently still looking for international, but in all cap space. Because remember, the current one is smaller companies. We want an all cap product as well. So we are actively looking for that. in conversation. At the moment, I'd say there is an elevated amount of incoming inquiries from small boutiques, subscale boutiques, and fund managers elsewhere who see the Polar model. And actually, if you're a small boutique managing $1 billion to $5 billion, it is very, very tough because you're carrying overhead, regulations going up, and Polar is a natural home for a performing manager. So we are getting a lot of incoming inquiries at the moment, looking at a lot of opportunities, but we are being very discerning.
Okay, thank you. And how much gross inflows are from new or existing investors, i.e. how successful are your marketing team bringing in new interest?
So I would say certainly the emerging market flows, which has dominated the flows over the period, that's all new clients. So that's new clients to Polar, and again, a new distribution channel. So a lot of Nordics there, some interest in Asia coming in. So the marketing team have been tremendously successful, both marketing and the sales team, actually. I mean, the whole digital marketing, which we invested in 3-4 years ago, has really paid dividends because we're getting through to many, many more new investors than we were in the past. And I think testament to that is just how the emerging market team has grown, because a lot of that flow is for new Polar clients, not existing clients. We are seeing existing clients coming out of some funds and going into others. So the client base is very developed. And you can see on that one slide I showed you gross in and gross out on tech. Those will be existing clients coming out and then re-weighting up. So effectively changing their tech weighting in their portfolio, which is why you're seeing gross out and gross in coming into tech.
Excellent. Well, thank you. That is it for the questions today, which just leaves me to thank you both for your time today and our listeners for joining us. And we look forward to having an update in another 6 months.
Thank you all very, very much for listening. Thank you.
Thank you, everyone. Thank you for your support.